All right, today we're diving into a real head-scratcher from GitLab's latest earnings report. I mean, they delivered some seriously strong results, but the stock? It just took a nosedive. We're going to unpack this whole beat and drop paradox and figure out what's really going on with the company. Let's get right into it.
So just look at this. On the surface, everything looked fantastic. You've got revenue up a solid 25% year over year. Non-GAAP earnings, they didn't just beat, they crushed the consensus by 25%. And then, the market's reaction? An 8.5% drop in the stock price after hours. So what gives?
To solve this puzzle, let's start with the big picture, the headline numbers from the quarter. I mean, just look at the scale of this outperformance. Revenue came in at $244.4 million, which was well above the $239 million Wall Street was looking for. And those non-GAAP earnings? A solid 25 cents per share, easily clearing the 20-cent consensus. You really can't argue with that. By any standard measure, this was a very, very strong operational quarter.
And this chart right here, it just lays out that disconnect perfectly. You've got a solid beat on revenue, an even more impressive beat on earnings, and then this starkly negative reaction from investors. This is the mystery we need to solve. Okay, so now let's start peeling back the layers, because this is where we find the real story behind why the market reacted the way it did.
You know, if you're a bull on GitLab, there is a lot to like here. Their non-GAAP operating margin expanded by 500 basis points. That's huge, to an impressive 18%. Adjusted free cash flow was strong, over $27 million. Dollar-based net retention is still healthy at 119%, and they keep growing their biggest customers. The ones spending over $100K a year are up 23%. This is a fundamentally healthy business.
Okay, but here's where we start to see the first little crack in that shiny exterior. While those non-GAAP numbers were great, on a GAAP basis, that's the one that includes big expenses like stock-based compensation, the company actually reported a net loss of $8.3 million. That's a reversal from a profit a year ago, and for investors who really look at the quality of earnings, that's a red flag.
But the real kicker, the thing that really sent investors running for the exits, was the forward guidance. Now, they did raise their full-year outlook, which is good, but the guidance for Q4 implies that their revenue growth is going to slow down to about 19%. For a high-growth, high-valuation tech stock like this, any sign of deceleration gets punished severely. This is what spooked everybody.
Now, to their credit, management was pretty upfront about why they were being so cautious. They pointed to three main headwinds. First, gross margins are getting squeezed by the high costs of their AI and cloud investments. Second, they're still seeing weakness in the small and medium-sized business segment. And third, it's just taking longer to close deals in the US public sector.
So this really sets up a classic narrative battle, right? You've got management's long-term vision on one side and the market's short-term doubts on the other.
On one hand, you have management painting this picture of profitable growth, all powered by this amazing next-gen AI-native platform. But what are investors hearing? They're hearing execution risk, they're hearing near-term margin pressure, and they're hearing uncertainty around the recent CFO change. In this round, the market chose to focus on the risks.
And CEO Bill Staples, he tried to frame their whole strategy around what he's calling the AI paradox. The idea is pretty simple. Yeah, AI can generate a ton of code really fast, but that doesn't mean it's good code or secure code. He's positioning GitLab as the essential platform you need to manage all that new complexity.
So what's their answer to this paradox? It's this thing called the GitLab Duo Agent Platform. And listen, this is a huge strategic shift for them. The plan is to manage the entire software lifecycle, plug into all the major AI models, and, this is the crucial part, create a new revenue stream based on usage. This moves them beyond just selling seats and into monetizing the actual activity on their platform.
So the next few months are absolutely critical. Back in September, their CFO left, which created some leadership uncertainty. This month, the Duo Agent platform is expected to become generally available. That's the key product catalyst. And then in January, the new CFO, Jessica Ross, who is a seasoned vet from Salesforce and Stitch Fix, she officially comes on board.
Okay, so putting it all together, what do we think is going to happen next quarter? Here's our take.
Look, we think GitLab is going to hit its Q4 guidance. They've been pretty cautious, so they should meet those numbers. But we see the stock staying pretty much range-bound. The real catalyst, the thing that could cause a breakout, will be tangible proof that this Duo Agent platform can actually drive new, high-margin revenue. Until Wall Street sees proof of that monetization, the stock is probably going to trade sideways.
So for us, that lands GitLab with a market perform rating. In our view, the company's solid execution and their really compelling long-term strategy are pretty fairly balanced by those immediate headwinds we talked about: the margin pressure, the leadership transition, and the macro uncertainty.
And as always, just a quick reminder, this is not financial advice. Make sure you do your own research before making any investment decisions.